Did you know that you can beat 90% of stock market investors without ever picking a stock? And if you do the strategy the right way, you can turn a $100 stock market portfolio into a $10,000 stock market portfolio. Not overnight, but over time. What's up, everybody? I am Jaspreet Singh from theminoritymindset.com and welcome to The Minority Mindset. I've been talking about a lot of things that are happening in the economy on our YouTube channel, from the oil crisis to mortgage rates to the credit system. Well, if you're a newer stock market investor, you're probably just trying to figure out how can you use all this information to make money in this crazy stock market. Well, you're in the right place, because in this video, I'm going to be going over how you can invest your money smartly and how you can take a small stock market portfolio with as little as $100 and turn this portfolio into something worth $10,000 or $100,000. It's all the same strategy. All you got to do is just scale the numbers. Investing in stocks, especially if you're a newer investor, can be very overwhelming because you have a lot of moving pieces. I mean, you have companies and stocks, you have dividends, you have financial statements, you have stock charts. It can be a lot. And to top that off, you are competing against an expert on Wall Street making $1 million a year to devote themselves to the stock market and know everything about the stock market. So how in the world are you supposed to be able to compete with them? Well, it's actually easier than you might think. By the time we're done with this video, you are gonna know how you can beat the majority of investors, even if you have no idea on how to analyze a company or how to even buy and sell a stock. So make sure you watch this video until the end, because you don't want to miss any of these key details. But before we get into that, hit that thumbs up button below, because if you don't, then YouTube doesn't share our video with anybody else. Subscribe to the Minority Mindset YouTube channel, that way you don't miss our new financial education videos every single week, and hit that little notification bell too, because if you don't, then YouTube doesn't let you know when our new videos are released. Most people think that stock market investing is about picking stocks. Like, how can you find the next Amazon before it becomes Amazon? That's one of the biggest lies out there, and it's one of the reasons why 90% of investors lose money in the market. There is a business for this on how to find the next big company, but there is a lot of time and energy and investment knowledge required to do this the right way, and unless you're planning on devoting a big chunk of your life to the stock market, this is not for you. If you get into this game, you're going to be spending a lot of money on how to find the next big stock pick, and the only person that's going to be getting rich on making these stock picks is the person selling these stock picks, and not you. Look, stock picking is fun, and I think that can be a part of your portfolio because, you know, it keeps things interesting. But do you know when the majority of people buy a stock? It isn't when no one's heard of this random company that's innovating, that's about to break out. It's after this company has already seen a huge run and now is on the news because it is the next big thing. But if you're hearing it on the news, you already missed the rally. I'm going to say this again. There is a way to find these companies and invest in these companies and make a lot of money doing that. But if your goal is not to spend a whole bunch of time trying to study the markets and become a professional stock market investor, then this is not for you. Stock picking takes a lot of time, and you need to know how to filter out your emotion, because emotion is one of the biggest killers on the stock market. But just because you shouldn't be picking stocks doesn't mean that you shouldn't be investing in the stock market. What you should be doing is investing in ETFs, exchange traded funds, that match your risk tolerance. You can think of an ETF kind of like a big group of stocks. Now, instead of you going out and just buying the McDonald's stock, you can buy a fund that is comprised of the McDonald's stock and the Disney stock and the Facebook stock and the Amazon stock. If you invest all of your money in the McDonald's stock, and then people start going to McDonald's and they start eating fries and they find something really nasty in their fries. Ew, did you say they put guacamole in their fries? Wait, that's actually not a bad idea. Hypothetically speaking, if people found guacamole in their fries, then the McDonald's stock might go up because they're being innovative. But if people found something nasty like fingernails in their fries, then their stock might tank, and so would your investment. That's a risk you probably don't want to take, especially as a smaller investor, because now all of your money is invested in one company and you can't control what they do. So if they screw up, then you screw up. If you're looking for a way to just invest your money and grow your money, then you want to make sure that your money is safe as possible with big upside. Typically, you want to be investing in something like 3 to 7 different ETFs to give you exposure to different markets. But if you're just starting with $100, then 1 or 2 ETFs is plenty. You can add more into your portfolio as your portfolio gets bigger. Remember what I said in the beginning of this video about understanding your risk tolerance? Well, this is where understanding your risk tolerance comes in handy. There are ETFs for almost anything, and the funds that you invest in are going to depend on how aggressive that you want to be with your money. If you're looking for that stable and steady growth, then you should be investing in funds that mimic the general stock market. VOO and SPY are the two most common names here because both of these funds will give you exposure to the top 500 companies in the stock market. So if the stock market goes up, so will your fund. If the stock market comes down, your fund goes down. Before I go any further, let me just remind you, I am not telling you what to invest in. I'm just giving you examples because investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so make sure you do your own due diligence and don't just blindly listen to a random guy on YouTube. Who you calling random, Jasprit? If you want to be more aggressive with your money and like you want a piece of some of the hot tech stocks out there, then you can look into investing in a tech ETF like VGT and OGIG. You can invest in startups with growth stock ETFs. You can invest in healthcare with healthcare ETFs, and you can invest in foreign and developing countries with emerging market ETFs. Now, you don't have to try to differentiate and fight between companies. Like you don't have to decide, should I invest in McDonald's or should I invest in Domino's? Now you can get exposure to a whole industry by investing in an ETF. Finding ETFs is pretty straightforward. All you have to do is go to Google and then enter in what industry you want to look in and then add the word ETFs. So if you want to find bank stock ETFs, just go to Google and search bank stock ETFs and you will see what there are out there. Plus, you'll be able to see which companies an ETF is invested in. That way you can see which companies you're getting exposure to by investing in a certain ETF. Generally speaking, your general stock market ETFs are going to come with less risk than your specific sector ETFs, like let's say the tech stock ETFs, because now you're getting exposure to more things. But this is where you need to know, okay, do I want more risk or do I want more stable growth? This is where you really need to understand your goals and make sure that your goals align with your risk tolerance. And I'm going to put some numbers on this in just a minute so you can see what it takes to grow a $100 portfolio to a $10,000 portfolio or bigger. But before I get into that, I want to show you how you can actually invest in these ETFs. If you want to invest in stocks, you have to use a stock brokerage, and you want to make sure that your stock brokerage isn't charging you excessive fees or commissions because you want to make sure that you're using your money to invest instead of using your money to make your broker richer. That's why I recommend our sponsor Webull, because it's free to open an account, it's easy to use, and they don't charge you a penny to make a trade because they are a commission-free brokerage. Plus, you can research all your stocks and ETFs right on their platform. I'll show you how to do it. So you open up their app and then you enter in which stock or ETF you want to look for. I'll just pull up VOO. So you go to VOO and here is their current trading information. And then if you scroll down, you will see a little button called Asset Allocation. So if you click that button and you scroll down, this will show you where this fund invests its money. So you'll see that 90% of its funds are invested into stocks. Then you scroll down a little bit more, you'll see what sectors this ETF invests in. So technology, healthcare, financial services. And then if you scroll down a little bit more, you'll see actually the top 10 companies that this ETF invests in as well. Back before May, Webull had a promotion where they would give you 2 free stocks just for investing with them. And I have some good news. They have brought that promotion back. You get your first free stock just for opening a free account with Webull, and then you'll get a second free stock valued between $12 and $1,400 when you deposit $100 into your account. So if you want to open your free account and see how you can get your free stocks, I got the link to where you can do that in the description below. Minority Mindset is a partner with Webull, so if you use them, we will get compensated, but there's no additional cost to you. I mean, it's free to open an account, and they don't charge you a penny to make a trade. So if you want to learn more, start investing and see how you can get your free stocks, I got the link to where you can do that in the description below. All right, now we got the basics down. You know how to invest, you know about your risk tolerance, and you know how to find an ETF. Now, how do you turn a $100 portfolio into $10,000? Well, it's all math. The historical average stock market return is 10% a year. Now, that doesn't mean that the stock market's gonna go up by 10% every single year. That means something like, okay, one year the stock market might go up by 30%, and the next year it might go down by 5%, and on and on and on. But over the long run, the stock market has gone up by around 10% a year. At the same time, the majority of stock market investors lose their money even though the stock market goes up over the long run because they don't have the right education. Or maybe because they were trying to trade hot stocks, trying to get rich quick. or maybe because they were trying to trade on emotion, or maybe it's a factor of all of these. But you have the right education now, so let's start with the most conservative approach. Let's say you only have $100 to invest today, and then every month you add in another $100 into your portfolio, so that's $1,200 a year that you can invest. And you just take this money and you are putting it into a general stock market ETF like VOO or SPY, and now you're just trying to match the stock market. If you do this every month, you just throw $100 into your investment portfolio and you just put it in this one general stock market ETF, and you're just trying to match the market. You're getting a 10% return a year. Now, you will have a $10,000 portfolio in just 6 years. Now, you're not trying to pick the perfect stock or trying to find the next hot stock. You are just trying to match the market. The 3 factors that will determine how much money or wealth you make in the stock market are how much money you invest, how long you invest for, and what returns you get. The longer you invest for and the more money you invest and the better returns that you get on your investments, the more money you'll make. But what you might find interesting is that your returns don't grow in a linear line. They actually grow on a curve like this, because the more money you put in and the longer you put your money in for and the longer and better your interest rates are, then the better your returns will get. And now you're not just growing your money, you're compounding your money, which means now your money is making you money and the money your money made is making you money. So you're adding speed on your side, which means the longer you do this, the faster your money will be making you money. Now, I get it. Investing your money can be scary, especially when we're in a recession like we are in right now, because you could invest your money and then see your stock market portfolio go down, and nobody wants to open up their portfolio and see red. But what you have to remember is the real money isn't made over 2 months. The real money is made over the long term, and that's what you're going to be doing here. If anything, when prices crash, you should be buying even more aggressively, because that means it's an opportunity for you to buy great investments at a discounted price. But now let's say you want to be a little bit more aggressive with your money and you want to be involved in the tech space because you really like tech and you think that's the future. Well, then you can invest your money into something like VGT, like I talked about earlier. And over the last 10 years, VGT has gone up by about 18.5% a year. And over the last 5 years, it's gone up by around 20% a year. Now again, past performance doesn't predict future performance, and investing in one specific sector comes with more risk, but also the more potential to make more money. Now, if you do the same thing and you get the average 18.5% return a year, which isn't guaranteed, but if you do, then you will have a $10,000 portfolio in just 5 years. And that's just $100 a month. Imagine if you invested $200 a month, or $2,000 a month, or $5,000 a month. The key here is consistency. And picking stocks is fun, but it's not profitable for the majority of people. I mean, are you in this game to do what's fun or to make money? Like, if you want to pick stocks, that's fine, but then you need to actually put in the work and devote your time, effort, and resources to learn how to do it the right way. But this is where financial education is so important, because it allows you to compete with the big time investors on Wall Street without having millions and millions of dollars to invest, because you can just put your money into the right funds and let the funds do the work for you. And again, if you're looking for an easy way to up your financial education, we have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. You can get a free ebook and sign up for our financial education emails by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are different from our financial news emails. Thank you for watching. If you enjoyed this video, share it with one friend, that way we can help spread the word. If you want to learn more about the 7 tips that you need to understand to be a successful stock market investor, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.